Welcome to our introduction to financial statements. In this lesson, we are going to cover the income statement, what goes on it, its purpose, and its layout. The income statement captures a company's revenue, expenses, and after-tax profit over a period of time, and this can be either a month, quarter, or a year. It is also known as a profit or loss statement since it shows the bottom line or net income, and operating statement as it shows the net financial result of a company's operations during a certain period. So to show up on an income statement, each item must correspond to only the period shown on the income statement. So for example, if you purchase a building that's going to last 10 years, then that purchase won't show up on the income statement, but if you're leasing, then the lease payments for that period in focus will be listed. Items must also affect the company's taxes. So for example, paying debt principal does not affect taxes, so it doesn't appear on the income statement, but the interest paid on debt does, since it is tax deductible. Now let's look at the components of income statements. At the very top, we have our revenues or sales, and it's the value of the products or services sold. And keep in mind, it's not the money that we obtain from selling, as that could be in credit or in cash. Next up, we have our cost of goods sold or COGS, and represents the costs directly associated with the sales of those products or services. For example, for our company Libra, our scale producing company, COGS will be the raw materials used to produce the scales. So it is also the costs directly linked to revenue sales. So by taking COGS from revenue, we end up with our gross profit number. And you may have also heard of gross margin. That's gross profit. So gross profit, GP here, divided by revenue equals our gross margin. And that tells you how effective a company is in generating revenue from its direct costs of producing that revenue. Our next item is operating expenses, or OPEX. It's also known as SG&A on a lot of income statements, and those are expenses that are indirectly linked to revenue and include employee salaries, rent, sales costs, marketing, administrative expenses, and research and development. So subtracting the operating expenses from gross profit gets us to our earnings before interest, taxes, depreciation, and amortization. I know it's a handful. And it is also known as EBITDA. So it is the profit after subtracting COGS from revenue. And it's asterisked here because it's generally not listed in an income statement, but nonetheless, it's an important figure which is widely used to gauge the profitability of a company's core operations before the effect of extraneous factors such as capital structure, leverage, and non-cash items. And just a side note here, you may have noticed by now that the positive items are denoted in green, whereas the negative items are denoted in orange. So on the next slide, we'll continue with the rest of our income statement. Moving on, we have our non-cash expenses such as depreciation and amortization, or D&A, and stock-based compensation. So depreciation and amortization are non-cash expenses and are methods to spread the acquisition costs of capital and intangible assets over its useful life. So since those items are useful for many years, the costs are allocated over those years rather than all at once at the time of acquisition. In the case of Libra Incorporated, our equipment and factory will be considered capital assets and thus depreciated over time, whereas our innovative scale patent will be an intangible asset and amortized over time. One thing to note is that depreciation and amortization are often embedded within earlier lines, such as COGS or operating expenses. To find those figures, you might have to dig in the statement of cash flows or in the note section of an income statement. Stock-based compensation is another non-cash expense as it represents the cost of paying employees through stock or stock options. And just to be clear, this is a very real expense as it will dilute the equity of existing owners. Also, just like depreciation and amortization, this figure may be embedded within operating expenses. After subtracting non-cash expenses, we end up with our operating income or earnings before income and taxes, or EBIT for short. Below operating income, you will find other income and expenses which are derived from a company's auxiliary activities and are not a part of a company's core operations. These include interest income and expenses, gains and losses, write-downs, and impairments. Pre-tax income, or EBT, is a result of operating income after those other income and expenses. Income taxes are then paid on pre-tax income, and then we get to our net income figure, which is also known as the bottom line or after-tax profits. Once again, we'll take a look at the real income statement of Apple as of fiscal year 2019. This means that all these line items correspond only to the fiscal year of 2019 and is not a running total like the balance sheet. At the very top, we have our sales figures right here, then our cost of goods sold. In the case of Apple, they embedded depreciation and amortization within cost of goods sold, but have also separated out those items within COGS. As you can see, pure COGS, so cost of goods sold excluding depreciation and amortization, is 150 billion, while depreciation and amortization is 11.3 billion. So sales minus cost of goods sold gets us to our gross income figure. So in this income statement, operating expenses is simply denoted as SG&A, or sales, general, and administrative expenses, and encapsulates research and development along with other SG&A. Subtracting SG&A from gross income gets us to our EBIT number, or operating income, right here. So after EBIT, we have our non-operating income and expenses and our interest expense. So non-operating income and interest expense. This gets us to our pre-tax income, and then we subtract our income taxes right here to get a net figure or net income of 55.26 billion. And working backwards, we find that, so 10.48 divided by 65.74, we find that the effective tax rate of Apple is only 16%. Okay, so now we're back with our company, Libra Incorporated, and this exercise we're going to walk through the following year one results and record them together on the provided income sheet. So some of these line items may look familiar as we've recorded them on a balance sheet, but the net income figure that flows through to retained earnings will be different as we've added other line items for the sake of demonstration. In real life, net income figure from the income statement will be added to retained earnings, so there should be no discrepancy. Now, just going down the list, we have our sales figure of $100, materials or COGS are $50, cash wages of $8, and stock wages of $2. We spent $4 on sales and marketing, $2 on research and development, $2 on utilities, and we also prepaid $10 for a 10-year insurance policy to get a discount, of course. To make sure that we're the best in class when it comes to skill making, we hired on a consulting firm that has billed us for $5 worth of services in which we've only paid $2. We also have $50 worth of equipment that depreciates on a straight line basis with a useful life of 10 years. Same with our factory, which is worth $200, but its useful life is 20 years. Aside from our capital assets, we also own a patent or intangible asset that's worth $50 and will expire in 10 years. And since we took out a loan of $100 at a 4% interest rate, we will also have to bear in mind to enter that expense as well. And finally, we're going to assume a tax rate of 21%, which is the current corporate tax rate. So you can try to tackle this on your own using the provided Excel sheet or follow along as we complete the income statement together. Okay, so let's get started with recording our results for the year. We'll first start off with our revenue figure, and that's how much we've sold in scales in dollar terms. Notice I didn't say it's how much money we've received for our scales, and that's because it may not be entirely paid for in cash. As we saw in the balance sheet, a portion of the sales were made on credit. So go over here, revenue, and we'll put in $100. Next, we'll record the direct costs for the scales sold. That would be $50. Put a minus sign here. So same with revenue, the costs incurred is not paid entirely with cash. As you can see, the $50 here is in parentheses, and that's to denote that it's an expense and should be subtracted. It also makes it cleaner to calculate the end result. In this case, that's gross profit, as you can see here. And we can use the sums function, so that is alt equal sign. And that gets us to the end result from revenues minus COGS, and we have our gross profit. Just remember, there are various formats, and many will keep expenses as a positive figure, so it's up to you to know that you're supposed to subtract it in this case. Also, since we're on the topic of formatting, you can see that we've kept a dollar sign on the very top, but removed it from the rest of the items here. Now, this is just a cleaner way of presenting financial statements, and it all comes down to preference. If you go back and look at Apple's income statement, you can see that there are no dollar signs, and that's because it's stated on the header that all figures are in US dollars. So with revenues of $100 and COGS of 50, we have our gross profit, which is $50. Next, we'll move on to sales, general, and administrative, or SG&A. So just a side note here, SG&A is often interchangeable with operating expenses, so don't get caught off guard if either is used. Okay, so within SG&A, we've broken out these items into labor, sales and marketing, research and development, consulting services, utilities, and insurance. And just so you know, many of these items will never be listed out separately, but for the purposes of this exercise, we have lined them out. Okay, so we'll input $8 for labor, as we've spent cash for this amount, $4 for sales and marketing, $2 on research and development, and that's because we're in the business of making the best scales possible, and $2 on utilities in order to keep the lights and machines on. For consulting services and insurance, there are two key points that need to be addressed. So for consulting services, since we have used up $5 of services, we will input $5 here, even though we only paid $2 in cash. Since $2 was actually paid, there will be an entry on the balance sheet of $3 as accrued expenses under current liabilities. For insurance, since $10 was paid upfront, but only 1 year of the 10-year policy was used, we would record $1 on the income statement. However, on the balance sheet, $9 will be recorded as a prepaid expense under current assets. So we will record $1 here. As you can see, in both cases, only what was used during the year was recorded in the income statement, no matter if it was paid in full or paid partially. So we'll just sum up our SG&A items here. But don't forget, we're going to make this a negative number in order to capture that it's an expense. After accounting for SG&A or operating expenses, we are left with earnings before interest, taxes, depreciation, and amortization, otherwise known as EBITDA. Remember, in most income statements, this item will not be listed, but nevertheless, it's important to know how it's derived. So our EBITDA number here would be our gross profit plus our negative SG&A or operating expenses. Next up, we have our non-cash expenses such as depreciation, amortization, and stock-based compensation. So in the case of depreciation, we've broken out factory and equipment. And to input the depreciation and amortization amounts, we would divide the cost or book value of the item by its useful life. So in the case of the patent, its useful life will naturally be how long the patent is in effect. So we'll go ahead and make the calculations here. For equipment, our equipment was worth $50. So it'll be $50 divided by its useful life for 10 years, which is $5 per year in depreciation. For a factory, it's similar. So we have a factory that's worth $200 in book value or cost, and we're going to divide that by its useful life. In this case, it's 20 years. So it's going to be $10 per year depreciation. Amortization will be the cost of our patent, or I guess the book value of our patent, or what it's worth, divided by how many years till expiration it has. So in this case, amortization is going to be 5. We'll go ahead and add up our depreciation numbers as well. And don't forget, since it's an expense, even though it's a non-cash expense, we're going to make these negative numbers. Okay, since we want to incentivize our employees, we've decided to pay them $2 of wages in stock. So we'll input that figure here under stock-based compensation. So to get our EBIT figure, we're going to have to take EBITDA and subtract out our non-cash expenses such as depreciation, amortization, and stock-based compensation. So you can see here we have an EBITDA figure of 6. Now we have to pay interest on our $100 loan that had an interest rate of 4%. So that will be $4 for the year. Don't forget we have to add a negative here. And that gets us to a pre-tax income of $2. And we also have to take taxes out of the $2 pre-tax income. So what we're going to have to do here is tax rate is 21%. So we're going to do 21.21 times our pre-tax income of $2. And it shows up 0 here. Actually, we have to add a negative sign here. It shows up 0 here, but if we move out a few decimal places, we can see that it's actually 42 cents. And after taking out taxes, we have our net income or bottom line, which is only 1.58 or $1.58. So as you can imagine, our business is not very profitable. We started off with a revenue or top line figure of $100 and only ended up with 1.58. So what this means is that we have to look at ways to increase our efficiency, which often means reducing costs. So that could either be done through reducing our SG&A expenses or operating expenses, or through reducing our cost of goods sold, our COGS. So if that's unsuccessful, then we have to look at ways of increasing our revenue figure. And if both those things are unsuccessful, then we may have to shut down the business and look for another line of work. So not to sound grim, but there you have it. There's the income statement for Libra Incorporated, our premier scale manufacturing company. And hopefully see you next time for our statement of cash flows.